The story begins in Europe. Private banks discovered a simple secret. By creating money as debt, they could earn interest without limits. Governments, desperate for funding during wars and crises, borrowed billions. On paper, it seemed like mutual benefit, but in reality nations were trapped. The more they borrowed, the more dependent they became on these invisible bankers. Early crises like the Napoleonic Wars' financial strain showed a pattern. Those who controlled credit controlled the outcome of nations. And the public, rarely aware of these machinations, bore the consequences through taxes, inflation, and reduced freedoms. By the 20th century, this system expanded globally. Central banks like the Federal Reserve in the United States were created, ostensibly to stabilize economies. But their structure granted unprecedented power to private banking interests. Decisions about interest rates, money supply, and credit allocation were no longer transparent. Entire economies now danced to the tune of institutions hidden from public oversight. As nations increasingly relied on debt for infrastructure, wars, and social programs, the cycle intensified. Countries became dependent on loans that could only be repaid with more debt, creating a perpetual loop of financial control.